Thank you for listening, and thank you to the Georgia Professional Tennis Association for having me give this talk. Let's talk about what we're going to cover today, and then I'll review my background in this area so you know where this information is coming from. We're going to talk and we're going to discuss what deductions are. We'll review what it means to write off an expense, and we'll cover some of the main deductions for tennis pros, many of whom are small business owners, especially if you're a contractor. We're also going to cover how you can save loads of money by properly managing your credit during the year, even if you only have personal credit cards, which you might be using for business expenses. Now, my background is that in addition to my tennis career, I've been a trained journalist for many, many years. I've got 2 journalism degrees. So, this is not going to be a talk based on my personal advice. I've written more than 1,000 personal finance and small business articles during my career, and for those articles, I've contacted CPAs and tax accountants and other professionals, and then I pass this information on to you. So, when you file your taxes, you can take the standard deduction offered by the IRS each year, which is a lump sum amount, or you can choose to itemize or write off individual personal expenses. Whether you choose to take the standard deduction or itemize, you can also write off business related expenses such as balls, hoppers, and PTA, PTR, or USPTA dues. Talk to your tax preparer about the standard deduction or if you should itemize. So, what is a write off? Let's say you generate $130,000 in revenue this year from lessons, stringing, anything else you do. And you have $30,000 worth of expenses, which could be anything from your website to balls to mileage. So your net income is $100,000. If you pay 20% in taxes on $100,000 in income, your after tax income is $80,000. Now, what if you can write off another $5,000 in expenses? Well, if you can write off another $5,000, that doesn't mean that you pay $5,000 less in taxes or $75,000 instead of $80,000 this year. What it means is that you had $35,000 in expenses last year, not 30, and now your net income is 95,000 instead of 100,000. So if you're paying 20% in taxes on 95,000, you're going to pay $19,000 in income tax this year instead of $20,000. So that $5,000 worth of expenses is going to save you about $1,000 in taxes. You can write off your write-off benefit for a $15 ball hopper, for example, then is about $3 in taxes you don't have to pay this year. So it's important to understand that when you write something off, it doesn't mean it's free. If it's a business expense, yeah, you're not going to have to pay taxes on it, and you can write it off that way. But again, you're not getting $5,000 worth of benefit when you write something off. Now, one of the biggest deductions for teaching pros that many of you miss is your mileage deduction. For 2020, the IRS mileage deduction was 57.5 cents per mile. That means for every mile you drive for your business, you can claim a business expense of 57.5 cents. Now, the mileage deduction covers the expenses to operate and drive your car. It includes your gas, oil, tires, air filter, and repairs. So if you claim the mileage deduction, you can't claim those individual expenses as well. And it also covers the actual cost of your car. Now be careful when claiming mileage deductions. If you're an employee and you drive to your club each day, you can't claim that commute. If you are a contractor who works at only one facility and you drive to that location each day, you can't claim that mileage because it's considered a commute. Now, if you're driving to several subdivisions, clubs, and facilities, you can deduct that mileage. If you drive to the PTR Symposium on Hilton Head Island or the USPTA Annual Convention in Lake Nona, you can claim that mileage deduction. If you drive your ball machine to be repaired, this is considered a business trip and you can deduct that mileage. If you go to the printer to drop off flyers you want copied, and then you drive back the next day to pick them up, you can claim the mileage for those 2 trips. What about a home office? There's this persistent myth that if you claim a home office deduction on your taxes, it's a red flag to the IRS, and it's going to increase your risk of an audit. The IRS does not have time to go after tennis pros or most other Americans with small tax liabilities. They want the big fish. Um, if you see this link up here, you can pause this and type this into a browser or write it down. These are the instructions from the IRS website regarding home offices. This was updated August 6th, 2020. I'll go over some basic rules for home office deductions so you can get an idea if you're interested in claiming one. Starting in 2018 and going until 2025, if you're an employee, you can't claim a home office deduction. So even if you run a large club's academy and do lots of paperwork at home, you can't claim this deduction. To qualify as a home office, for you contractors or you small business owners, your space must be used exclusively for conducting business on a regular basis. That means you can't claim a nursery as a home office if you put a desk in there. Um, Deducting a home office means you can claim deductions based on the square footage of the office and expenses related to that square footage, such as rent and utilities. You can write off all expenses for the office equipment, computers, supplies, and furniture. You want to ask your tax preparer how this works. Um, for example, if you put a home office in the corner of your nursery, you can't write that whole room off, but you might be able to write off that square footage. Now, home office expenses can include a computer, printer, phone, paper, toner, filing cabinet, desk, chair, floor mat, and other purchases made exclusively for your business. If you maintain a website and have social media presence directly tied to marketing your business, you might be able to deduct part of your internet connection costs. Regarding phones, the IRS considers the first line into your home to be personal, even if you use it partially for business. If you have a cell phone, however, you can deduct part of that expense, but only the part that you use for business. So you can deduct an amount equal to the amount of your business use. If you pay $100 a month for your cell phone and use it 75% for business to book lessons, check emails, send texts, pay bills, etc., you can write off $75 of your phone per month. Remember, you can take a home office deduction whether you own or rent. What about equipment and supplies? Obviously, tennis balls, hoppers and carts, teaching aids, court accessories, those kind of things you can write off because you need them to do your business. You need to talk to your accountant about whether or not you are required to pay personal business property tax. For example, if you buy a computer for your business, you can deduct that, but you might have to pay the business property tax on it depending on where you live. Whether or not you can deduct your tennis clothes is iffy. The IRS has determined that because you can wear tennis clothes for going out, like to the movies or dinner or grocery shopping, wearing around the house, you can't deduct them. To be able to deduct clothing and shoes, they have to be mandatory for your job and unsuitable for everyday use. So if they're suitable for everyday use, that's the thing the IRS looks at. Now, if you're receiving free clothing, shoes, and rackets, you are not required to declare these as income if you're required to use them for your job, if it's part of your contract. Your club is sponsored by Wilson or Head or Prince or something, and you have to use those rackets, you can, they're not income. If you pay an annual city business license, you can deduct that. The same goes for PTR, USPTA, National Tennis Academy, and GPTA dues. If you join ALTA in Atlanta, for example, or the USTA solely for business reasons, you can deduct those dues. For example, you might play in USTA leagues or tournaments, but if you want to serve on USTA committees, move up in the PTR and USPTA, receive grants, and otherwise improve your stature in the tennis profession, you probably need to be a USTA member. So you can write off those dues. And you'll also be better able to stay current if you receive their educational materials. If you purchase liability insurance from the PTR, USPTA, or other source, you can deduct that. If you pay for continuing education, such as an online workshop or annual conference, you can deduct that. If you attend a business-related course at your community college, you can deduct that. You can deduct business-related books, CDs, and website membership fees. Meals and entertainment, this is another tricky area. It's a big gray area. Again, I'm going to recommend that you ask your tax preparer so that you don't end up writing off dozens of meals each year and then wind up having to pay those back if you're ever audited. You generally can't write off meals you eat unless the reason you have for meeting is specifically related to your business. And then you can only write off 50% of the cost of the meal. So if two teaching pros meet for lunch every week and discuss how they teach the backhander ideas for marketing themselves, or they have other tennis-related discussions, those might not be considered legitimate business reasons because you didn't go there specifically to talk about a business venture. Now, as far as the 50% deduction goes, you're going to need to check every year. Right now, I think Congress has just passed the latest stimulus bill in December of 2020, and I believe they might have bumped back the business deduction to 100%. I'm not quite sure. You're going to have to look that up every year. We have a new administration coming in 2021. Who knows what's going to go on with the tax code there? So every year, you're going to need you probably want to talk to a CPA if you do your own taxes. Now, if a director of tennis and her head pro go to lunch to get away from clients and the phones and staff so they can discuss starting a new tennis academy, and they're going to talk about who's going to run the academy and how much they're going to spend on marketing and what they're going to charge, that's a deductible lunch. If you travel to Hilton Head to attend the PTR symposium, for example, or you ever go out of town for business, you can deduct all your meals while you're there, even if you don't talk business with anyone, because you are out of town for business. Now, whether or not you can deduct meals for employees is also something you should talk about with your tax preparer in advance. You may have heard friends tell you about how they write off their vacations each year by doing some business while they're on vacation. This is illegal, and if they are ever audited, they're going to have to pay for these expenses and may end up getting audited for multiple years. You can only write off the portion of any travel-related expenses that pertain to your business. If you have to travel to a tournament to watch your players, that's a business trip. If you want to write off a family vacation by attending a 3-hour workshop while you're there, you can't. That means if you fly to Lake Nona to go to the USPTA convention and want to stay an extra few days with the family, you can write off your room for the nights you attended the conference, but you can't include the 2 or 3 extra vacation nights you stayed, or any meals you ate or rental car you used on those extra vacation days. So be careful about that. You can generally write off all of your marketing expenses, such as flyers, brochures, if you have a website, a camera, if you buy a tripod for your phone so you can take videos, t-shirts, swag, food, prizes, beverages at special events. So that's a quick overview of how write-offs work. You want to try to keep receipts and keep records of every dime you spend on your business so that you can go over them with a professional and say, can I write this off? And they do add up. So let's talk about managing and improving your credit. If you don't make sure your credit worthiness and credit scores are as high as they can be, you'll qualify for fewer credit products, such as credit cards, auto loans, mortgages, small business loans. Many potential employers also ask to look at your credit reports during the application process or after an interview. So you want to keep your credit reports in good shape. If you're not looking for a new credit card and you're not shopping for a mortgage or thinking about buying a new car, why do you need to manage your credit on a regular basis? Well, the short answer is if you need a new credit card or you want to take out a loan, it's probably too late to fix or improve your credit before you apply. It can take weeks or months to optimize your credit reports and keep your scores as high as possible. And this isn't something you have to work on every day or every week, but a few times during the year you want to do some credit checkups. So that's why now is the time to make sure your credit and credit scores are in good shape. Some of the benefits of good credit include you're going to get lower interest rates when you do get credit products, you'll get higher credit lines, you'll have more access to credit, and you'll have fewer fees. So the first thing you want to do is to pull your 3 credit reports. Your credit reports include the number of credit cards and loans you have, the balances, your payment history, other information about your credit history going back many years, and it includes things such as previous employers and addresses where you've lived. Therefore, the first step to improving and managing your credit is to pull these 3 credit reports, which are created, maintained, and distributed to potential lenders by Equifax, Experian, and TransUnion. These 3 companies also generate 1 or more credit scores for you, or work with the credit scoring companies to issue a score for you. Now, each time you use credit, the credit card company, auto lender, mortgage company, or other lender reports your information to these 3 agencies. In exchange for helping these agencies keep tabs on your credit, lenders get to access your reports so they can evaluate your credit worthiness. And your credit reports will always say who pulled your reports. You legally have access to these credit reports free once each year. If you would like to monitor them throughout the year, you can purchase credit report updates from them or use a credit monitoring service. To get free copies of your credit reports, go to www.annualcreditreport.com, which is the official government site for doing this. You can also get your reports one at a time by contacting Equifax, Experian, and TransUnion individually, and that means going to the website. You'll need to answer a few questions about yourself at these websites, or if you send in a letter, such as your name, address, date of birth, and social security number. They might ask you some questions about other loan products. Have you ever taken out a loan from one of these 3 companies? And you might recognize one of them. Oh, that's my car loan. That's how they identify you when you're trying to get your reports. And that helps prevent other people from getting your reports. So how can you understand these reports once you get them? When you get the copies of your 3 credit reports, it's important to make sure that every piece of information about you on them is correct. That includes even small details such as your previous addresses, middle initial, previous employers, and birth date. Make sure there are no accounts on your report that don't match or have never belonged to you. For example, a credit card, auto loan, or mortgage. Your credit reports might contain negative or derogatory remarks. Now, these are things like late payments, missed payments, bankruptcies. You can go down the list here, and many of them are legitimate, and they can stay on your credit report for up to 10 years. Now, even if you have good credit, each time you receive a new credit card, that will ding your score slightly. That's considered a derogatory remark. Each time a creditor pulls your credit report with your permission, that dings your score. But these aren't major hits. That means you just need to be careful shopping for credit cards and giving multiple card companies permission to pull your credit reports. If you can't pay your taxes and you set up an installment plan with the IRS, that will not be reported to the credit reporting agency. So if you're having trouble one year, can't pay your taxes, you didn't do your quarterly payments like you're supposed to, call the IRS. They'll set up an installment plan with you, pay as little as $30 a month. You can pay over 6-7 years, and that won't go on your credit report. Now, some lenders do not report late payments if you are less than 30 to 90 days late, even if they charge you a late fee. Check with your lender to find out what their policy is. So how do you fix your reports if you find something bad? Well, if you find any incorrect information on your credit reports, get it corrected. If it's incorrect information, such as your address or date of birth, contact the reporting agency or agencies with this mistake and ask them to change it. So you would contact Equifax or TransUnion or Experian. Now, if a lender has incorrectly reported information, such as a missed payment, contact them first and have them correct the information. If they won't, then you can challenge the information by contacting the reporting agency. Follow the steps at the reporting agency's website to request a correction. You'll need to provide as much support as possible and wait up to 30 days for a ruling. If the reporting agency sides with the lender making the derogatory statement, you can then take legal action. You can also leave a comment for lenders who pull your credit reports explaining derogatory remarks. For the most part, however, lenders won't consider sob stories, so uh, consider what remark or what comments you're going to leave so you don't look like you're making excuses. All right. Um, so, uh, where are we now? Here we go. Uh, Once you've cleaned up your credit reports, it's time to start improving your scores. And you can do this by reviewing your current loans and credit cards to determine whether or not you can improve or replace them. You rank your credit cards by the annual percentage rate they have or they charge to see which ones cost you the most in interest each year. Look at which ones come with an annual fee. Look at which cards offer a balance transfer and what the terms are. Look at your mortgage to see if a refinance might be in your best interest. This can save you tens of thousands of dollars over the life of your loan. A refinance might also significantly lower your monthly payments. Even if you're just refinancing by a half a percentage, that might be a big deal for you. Now, anytime you're shopping for a credit card, contact credit unions for the best deals. They're nonprofit lenders, and they usually offer the best credit products in whether it's an auto loan, student loan, mortgage, in terms of low rates and zero fees. Now, what are credit scores and how are they different than credit reports? A credit score um, is basically a rating that you get based on your credit worthiness. How often do you make your payments on time? What's your debt to credit ratio? Things like that. And there are a variety of ways to improve your credit scores, but you'll first need to know what factors affect your score. Now, according to FICO, which is the main credit score reporting company, these are the factors that impact your score in order of importance: payment history, amounts owed, length of credit history, new credit, and credit mixed. Credit mix. If you log into your credit card accounts and check your credit score, you will see reasons that are affecting your score. Many of you do online banking. You have your credit cards, you set up auto pay, they give you your free score. You can take a look and you wonder why your score isn't high. One of the things, let's say, is proportion of balances to credit limit is too high. This means you are using too much of your available credit, such as more than 25% of your credit card lines. This is why it's important not to close credit cards after you pay them off. First, you lose the credit history for that card, which might be 10 years or older. Remember, length of credit history is 15%. And let's say that you have two credit cards, each with $5,000 worth of credit, and you have 2,000 worth of credit used already. You've already made 2,000 in charges. Your debt to available credit ratio is 20%. You've got $10,000 worth of credit. You've used 2,000, and so you got 20%. That's pretty good. Now, if you close one of those cards, you now have only $5,000 worth of credit, and that $2,000 in debt you have now changes your debt to credit ratio to 40%, even though you haven't made any other charges. And that, when we look at amounts owed and your debt to credit ratio, is bad. So don't close cards that you aren't using. Another reason you might see is too few installment loans. This means you don't have a car loan or mortgage or student loan. Installment loans are those that you pay the same amount every month, $100 a month, $85 a month, and these can help your credit score. So again, what affects your score? Your payment history. If someone does a hard pull of your card, um, that means that you're shopping for credit cards or mortgages or car loans, and you're giving people permission to pull your credit. Um, the two main credit scoring companies are FICO and VantageScore. When you get these free credit reports, with your credit history. But when you get your free credit reports from the three agencies, you don't get your scores. You have to pay for those purchases separately. And you can check your scores regularly using a credit reporting company. But those are not often the scores lenders see when they pull your reports. For example, if you've got 4 credit cards and you go and check out your scores, they're going to be 4 different scores. And you're wondering, why is this? Well, there are dozens of different scores on you, which are given to different lenders because those different lenders want to know different information. So, for example, credit card companies get one type of score, auto lenders get another score, mortgage lenders get a different score. And one of your credit cards might be using Experian, and another one of TransUnion's models. So if you have several credit cards and get a free credit score, don't be surprised if the scores are different. They're not wrong, they're just different types of scores. So um, again, later missed payments can also change your interest rates with credit products that you already have. For example, if you have a balance transfer at 0% interest for 12 months, if you miss one of your payments during that 12-month promotional period, you might lose your 0% interest rate and have to start paying the regular rate immediately. So late payments not only affect are on your credit report and affect your credit score, but can actually trigger some problems with credit products you already have. So, how can we lower our debt? One of the quickest ways to increase your credit score is to lower your debt or the amount of money you owe. However, not everyone can do that or do that easily. Um, if you do have some extra cash that exceeds your emergency fund, you might want to look at your credit cards and their APRs. If you can pay down $1,000 on a card that has a 20% APR, you'll not only raise your credit score, but you'll save $200 in interest payments this year, assuming you were going to carry that $1,000 for 1 year. There is one credit personal finance guru who says always pay down the card with the smallest amount first because it'll give you a psychological win and you'll be motivated to keep saving. To me, that's a little patronizing. Pay down the highest APR first. Another way you can get money to pay down your cards is ask family members to lend you money in a win-win situation for both of you. So if you have a credit card with 20% or higher APR, you might borrow money from a family member and offer to pay them 10% interest and pay them back in 1 year. So if 10% is more than they make in the market and you are a better risk than the market, then you both win. Because on a $5,000 loan, you'll save $500 in interest payments and raise your credit score because you reduced your debt to available credit ratio. Your family member earns 10% interest or $500. Now they might have to pay some income tax on that interest, but again, they're family or it's a close friend. And so that might be one way for you to get money to pay down your credit cards, and you can help somebody else as well if you can pay them back. So, in summary, tennis pros and coaches can significantly increase their incomes by reducing their taxes. Work with a professional tax preparer to learn all of the deductions for which you qualify. Managing your credit can save you tens of thousands of dollars over the course of your career. You can do that by eliminating unnecessary interest payments, reducing your interest rates, and eliminating fees. So, thank you very much for listening. Managing your credit is something that you're going to need to do over the course of a year, but it's going to be worth it. And working with a CPA, even for 30 minutes or an hour each year to do your taxes, can also wind up helping you a lot. So I hope this has been informative, and thank you very much.